Good morning. This is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. Well, here we are, the first Monday in December, and the markets are still moving forward. So two topics I'm going to talk about today is some of the healthy sector rotation I'm seeing, but also on the other hand is what some of the sentiment surveys are telling us. Okay, first off, we got the Dow trading above 16,000, big milestone, and it continues to stay up there. The NASDAQ above 1,800, another milestone. And of course the NASDAQ above, pretty healthily above 4,000. So that's another pretty good sign. So I want to talk about this healthy sector rotation. Back in October, as indexes were moving higher, a lot of the leading stocks started correct. We started to see that in some of the internet stocks like Facebook, LinkedIn, automotive stock, Tesla. And then we saw some of the biotechs, which were a leading index, also kind of got knocked down and started to correct as the indexes were moving higher. But now what we're seeing now is some of the stronger stocks, especially in the biotech sector, some of those have come back. Stocks like Biogen, Celgene, Gilead, Regeneron. So some of those names, the stronger stocks, are coming back up. So there was a mild correction. Now, in terms of sector rotation, in the whole medical sector, it was all about the biotechs, but now we see a lot of the drug stocks, which were lagging, they're starting to lead the charge. Stocks like Jazz, Questcor, Alexion, which is really a biopharmaceutical company or drug company, depends how you want to look at it, is also continuing to do well. Now, one major sector that's been lagging has been the financial sector. Now, over the last 2 weeks, the financials did take the lead. We see many regional banks hitting new highs. We see the super regional banks like, not regional, but the super big banks like Goldman Sachs, JP Morgan, Wells Fargo, all trying to get into new highs. So that's a healthy rotation because those were lagging. Also, last Friday in the shortened holiday, we saw the spider, the home builders, the XHB, testing its May high. Didn't quite get through it, so that's something, again, I'd be looking for. So underneath the hood, the markets still look pretty good because we have a very healthy sector rotation and it continues to move forward. Now, let's take a look at some of the possible negatives, and that's the sentiment surveys. These are contrarian indicators, meaning when everyone's extremely bullish, that's probably a bad sign for the market. And when there's no bears, that's also kind of a bad sign for the market, sort of indicating complacency. So if we look at two surveys, the AAII, that's the American Association of Individual Investors, the bullishness is pretty much at an extreme. If we look at the Investors Intelligence of Advisors Sentiment Survey, we see the bullishness also is an extreme, and there's very little bears, probably as little bears as we've seen in who knows how many years. So, however, you need to keep this in mind. These sentiment indicators are secondary indicators. Your primary indicators are price and volume. So you want to look at stocks that are still doing very well in price and volume. Now we'd be looking at some of the financial stocks. Some of the stocks I talked about over the last few weeks that we're picking up was Morgan Stanley, Charles Schwab. And over the last week, we're actually picking up the CME Group in Chicago. That stock broke out through a $78 level from a pretty tight consolidation. Their earnings have improved over the last few quarters. I think they'll continue to do well, especially with change in interest rate environment or perceived change in interest rate environment. They're going to come to CME to hedge that interest rate. But as always, as I say, don't take my word for it. Let price and volume be your guide. This is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago.